Hi, this is George IRR Martin, and today I want to share with you one of the most controversial names out there, and that is UnitedHealth Group, or UNH. I'm currently long on the company. I've opened a pretty significant position, but I don't want to convince you to buy the company. I just want to share my insights, what I've researched, a bit of what they do, and what has happened last quarter, and finally, why I think there's an interesting opportunity here. Before I do that, I do want to say that none of this is financial advice. Do your own research and always consult a licensed financial professional before making investment decisions. All right, with that out the way, let's jump right in. So, United Health Group, it's not just an insurance company, it is a managed care provider. What does that mean? That means that apart from insuring people, they also offer healthcare services to people in their insurance plans, but also people outside of them. So United Healthcare, that is their insurance branch, that's half their business. The other half falls under Optum. Optum includes Optum Health, that is a collection of clinics across the country, Optum RX, a pharmacy benefits manager, that's the middleman that negotiates drug prices for you, and Optum Insights, a portfolio of software businesses that gives service not only to United Healthcare clinics, but also the entire healthcare industry. Before I talk a bit about their business model, I want to go over a brief history lesson on how the company got to the position it's at today. So, the company was founded in the 70s. It grew into one of the larger healthcare players in the country. But things got really interesting in 2010 when the Affordable Care Act passed. So, that's Obamacare. When Obamacare passed, it made it a legal requirement to have healthcare in the United States. And to counterweight this surge in demand, the government also introduced something called the medical loss ratio. And what that says is pretty much for every dollar a healthcare insurer gets in premium revenue, they have to spend at least 85 cents of that dollar. So in effect, that's a government cap of 15% for gross margins for any healthcare insurance business. As you can imagine, this makes healthcare insurance not that attractive, and many players exited the space ever since. But with Stephen Hemsley, who was CEO then and who has just returned to the CEO position, what he realized is that it can still be very lucrative if you do two things. One is get massive scale, and secondly, accomplish deep vertical integration. Vertical integration allows you to do two things. One is diversify away from the insurance business and get into potentially more lucrative businesses inside of healthcare. But more importantly, it allows you to control costs. So I want you to take a look at this graph I made here on top. It kind of works like a virtuous cycle. So when someone gets insured by United Healthcare, they're going to go see a doctor that works at one of their clinics, Optum Health clinics. The doctor is going to prescribe them exactly what they need. And then Optum RX, their pharmacy benefits manager, is going to get them the best drug because they're going to use their giant size to negotiate the best prices for its customers. This also helps them minimize costs because, they're mostly paying for your drug as well. And lastly, you got perhaps the most overlooked part of their business, which is Optum Insights, which is a bunch of software products that are used by the entire industry. This allows them to collect data and build this massive data warehouse that gives them an unrivaled vantage point into what everyone else is doing, how much they're paying, and how well they should price their policies. And this goes all the way back to the moment that they offer a policy. They use this data that no one else has to offer the most attractive and precise policies in the market. So as you can see, it's kind of a virtuous cycle. This isn't just a conglomerate of random healthcare businesses. This is a very deeply integrated business model where every single part contributes in delivering value for shareholders as well as their customers. Let's jump into what happened last quarter. So if you take a look at the graph I have here on the top right, there we go. The company has been on a tear over the past 10 years. This has been an extremely successful business model. All of their competitors have tried to copy it, but none have reached the same size and success that UNH has. In fact, they haven't missed earnings for the past 20 years. So if you go all the way back to around 2010, you're going to see all these green dots, which each green dot represents them beating estimates. They continue to grow their share price, they continue to beat expectations, and then you have last quarter. So last quarter, they missed estimates for the first time in pretty much forever. And the company got sued by the Department of Justice, and that the CEO quit, and the stock price went from $600 all the way down to $300. If you take a look at the dividend history, you can see the success that I'm talking about. So ever since 2010, which is when Obamacare passed, the company has been increasing dividends consistently. They've been on a tear. But what has happened for them to suddenly stumble? Well, these are analyst projections on the street. You can see this is how projections change over time. The light blue line is 2025 sales estimates, followed by 26, 27, and 28. And you can see there's been pretty much no change to their sales estimates. In fact, they've increased. So they're not having a revenue problem. They're having a cost problem. So if you take a look at this chart on the right, oh, there we go. Okay. Earnings estimates fell quite significantly, and this can only be explained by an increase in costs. So we've seen massive inflation in the healthcare space, which has caused the market to question their ability to pass on price increases to their consumers, especially their government programs. Before we dive deeper into that, I do want to point out how cheaply the company is trading right now. So this is a range of earnings estimates throughout the street. It's currently trading at around 14 times forward earnings. If you're willing to go out to 2027, it is trading at 10 times. That's pretty cheap. If you go all the way down to 2028, it is trading less than 10 times the most bearish estimate of earnings. So yeah, the company's pretty cheap, but there's a lot of fear right now that the government's going to either break up their business or essentially regulate it to death. So UnitedHealth, as you can imagine, is a very complicated business. I'm sure you got the idea by now. But you might think, okay, well, we need to see a really complicated model that dives deep into all the different business lines, all the different factors. I got you one better, all right? I got you a very simple model that models the main variable that's going to move the stock price, at least in the short term, and that is the medical loss ratio. So UnitedHealth has four basic plan types. One is commercial, which is the normal insurance that you get from your employer. It's completely private sector. Then you get Medicare Advantage, which is the private sector giving service to Medicare enrollees. Medicaid, which is the same thing, but for Medicaid. These aren't retirees. These are simply less fortunate people who rely on this government program, and other government programs related to Medicare. When there's healthcare inflation, it's not really a big problem for insurers because they can simply pass on the price in their policies. And this is what they've done for the commercial policies. So there's not going to be a problem. In fact, healthcare inflation is good for healthcare insurers because they can grow their top line even more, right? If they're making 10% out of 100 and now they charge 120, they can grow their earnings 20% by keeping the same margin. So it's actually pretty good news for their commercial line of business. The problem comes to their government plans. So all these plans right here, I'm going to mark them in orange. As you can see, these plans are 40% of their business. That's pretty significant. And the problem is you can't just raise the price on Uncle Sam. So it's a very complicated process. You need congressional approval, and the government's going to try and throw wrenches at your price increases. They're going to try to pressure you with lawsuits, with political pressure. It's just very complicated, and I think that's a bit of what we've seen now. So I know the DOJ lawsuit seems pretty scary. It seems less scary if you realize that every single healthcare insurer has been sued by the DOJ during the past 5 years. So I read it more as just political pressure to get them from not increasing prices. It's especially bad when it comes to Medicaid. So we've seen Medicaid come under fire. In fact, the government has cut Medicaid pretty significantly, it looks like that business is not going to work. Before we start messing with the numbers, let's just go over the rest of the model here. So for every dollar of revenue, they're going to make, on a good year, 14%, pretty close to that maximum the government puts, because UNH is a very efficient company. They're going to have other costs like paying for employees, paying rent. You get the idea. They're going to get an operating margin of around 8%, trading at a historical 16 times multiple. They're going to trade at 1.3 times revenue. This is a company that makes lots of revenue. They made $400 billion of revenue last year. That's almost as much as Apple. So this is a very big company, but it's not as profitable as Apple, right? So the last year, the price was at around $600, and that's kind of our base here. Let's see what happens if Medicaid just disappears and it's not a business anymore. They're not going to make a single cent of profit from Medicaid. So I'm going to go up to Medicaid, put 100% medical loss ratio, so you're not making any profit. And the stock price is hit. It goes down by 24%. This is kind of where the stock price was trading a couple months ago when Trump got into office. I think the market kind of started to price that in. Let's take a look at what happens if all government programs become unprofitable. This is the worst case scenario. The stock is at $218. That's well below the current price, which is around $300. This is the most extreme scenario. It's very unlikely. I don't think that it's just going to be unprofitable forever. I think that the government will eventually pay for the new healthcare costs that these plans entail. But let's be a bit conservative and put 95%. And there you go. That's where we're at right now. So if you look at what the market is pricing in, it's pretty conservative, right? So you're only going to make 5% of their Medicare plans. Medicaid's not going to be profitable anymore, and that's where you get the stock price right now. I think that the government will eventually pay the proper prices for these Medicare and Medicaid plans. Why? Because people in these plans vote, and when they realize that the government is not paying for their plans and companies start dropping these plans or stop subscribing people, they're going to lose votes in the midterms. So I do think that, over time, the government is going to cede a little. So what we could see is, instead of operating at 95% medical loss ratios, we might see something like 90%. And there you go. You're already kind of at $400. That's not that bad. Let's assume this goes to 95. And I think another thing the government could do, instead of paying more for Medicare and Medicaid programs, the government could simply, they could say, we're going to lower the cap on the medical loss ratio. So we're going to let you make 80% here. And there you go. You're back to where you got there, right? So ultimately, I think the question is insurance still going to be a business? In my view, it is. And this is a attractive entry point because the market is being so pessimistic. But I'm going to change this to 85%. Let's say the new price when the storm blows over is $450. Let's take a look at what happens with our projected IRR. So the current price is at $300. You're getting a 50% discount. Historically, a company delivers 15% earnings growth. Let's say that goes down to 10% because the company has matured. No multiple expansion. It's going to stay at that historical 16 times. Dividend yield of 2%. Historically, it's been 1.5%, but the company, has matured. They should be paying higher dividends. And what do you get? You get a 16% 10-year IRR versus the market average, which is 7.5%. That's very attractive, even for the risk a company like UNH carries. That looks like a good opportunity to me. And I just want to cap things off with talking a bit about my thesis. I'm a long-term investor. I'm willing to buy when a company is very overlooked or very mistreated and wait a long time to see the market reprice. And I'm not saying that UNH is going to bounce back anytime soon, but I do believe in the long-term prospects of the company. I think it has an excellent management and a very wide competitive moat. This is a very complicated industry, and it's not going away anytime soon. And with that said, that's everything I have for y'all. Thank you for your time. I'm always on the lookout for comments and feedback, so please leave a comment and like and share. Thanks.